important numericals are covered over here, and very important objective questions are covered over here. So watch the series till the end. Let's start. First one. Read this. To calculate the VAR, value at risk, there are following approaches. Firstly, before going to the question, what is VAR? What is VAR? Value at risk means VAR. Look at this, VAR. What do you mean by this in simple terms? Okay, I'll give you a simple example. Suppose if I have invested in, let's say, a Reliance share. Reliance. Imagine, let's say the price of Reliance is right now at, let's say, 3000. Okay. Now what is my VAR? Is my VAR complete? Value at risk means what is my amount at risk? Is my amount at risk complete 3000? No. Suppose if this is the price of Reliance 3000, okay, and this Reliance share is fluctuating per day, per week, depending on my this tenure or my period. Suppose in a week, or let's say in a month. In a month, let's say Reliance is fluctuating 5%. Okay, so 5% here and 5% there. So it will be what 5%? It will be 1500 over here and 1500 over there. We are 5%. 5% into 3000. Okay, so it will be 1500 over here. It is 1500. So this is 1500. Okay, and this is 1500. This. Okay. 1500. So if it is fluctuating 1500 on both the sides in one month, let's say, then my VAR becomes what? My VAR becomes the total of this. The total is 3000. Okay, sorry, 3,300. Sorry, yeah, it becomes 300, right? Because the price was 3000. I took it for 30,000. Okay, so this will be 3,300. Okay, so 150 over here, 150 over here. So it will become 300. So my VAR becomes 300. So got it? What is VAR? The fluctuation which is happening in that stock is known as VAR. Now this example I gave you for Reliance, a stock. It can be a commodity, it can be a dollar, it can be a gold, anything. Okay. So to calculate the VAR, there are the following approaches. Correlation method, also called as variance or covariance matrix method. Historical simulation method, Monte Carlo simulation method, and Macaulay's duration. So the options are 1 to 4 all, B is 1 to 3 only, C is 2 and 3 only, and D is 1 and 4 or only 1 and 4. This is not 1 to 4. Okay. So what is the right option over here? Search in the Google. Have you read it? Anyone has read this? How to calculate the VAR? It's there in your module B. Okay, module B of your this BFM. So how to calculate? What is the method used? Everyone, let me see. What is the method used? It is 1 to 3 only. See here, it's not, Macaulay's duration is not used to calculate the value at risk. Macaulay's duration is used, Macaulay's duration is used to calculate that. What is Macaulay's duration? Macaulay's duration is that period of the bond in which the interest rate risk is zeroized. Interest rate risk equals to 0. Okay, that is the Macaulay's duration. Okay, to calculate the value at risk, the various approaches are based on the following basic parameters. So to calculate the VAR, what are the approaches that are based on the following parameters? So means all these approaches, or the 3 approaches which we saw over here. Okay, so they are based on what parameters? Holding period, historical time horizon, holding period, confidence interval, comma, okay, historical time horizon and confidence interval, holding period, historical time horizon and confidence interval, all the three. So what is the option? Correct option A, B, C or D? What do you say, guys? Think over it. Think of the answer. Think of the answer, everyone. Yeah. Is it 2, B or C? Is it B or C? See here, the correct answer over here is, okay, before that, before giving the correct answer, let me explain you. Value at risk. Okay. What are the parameters? So what do you mean by this word holding period? Holding period means for what time am I going to hold that bond? Means am I going to hold that bond for 2 years, 3 years, 1 year? Okay, so holding period is time. Time equals to holding period. Okay, so equals to holding, right? Second is what? Historical time horizon. Okay, let's look at this. What is historical time horizon? Historical time horizon means what is the duration for back testing I am considering. See, this back testing is an important parameter in your BFM. That's why I say join the batches as a back testing. Okay, because here everything is not able, I won't be able to explain everything. Back testing. Okay, so historical time horizon relates to that. Okay, historical, I'll just write the short form over here. Historical. Oh, only historical. TH I'll write, time horizon. Okay. Then confidence interval. What is confidence interval? See this. This confidence interval consists of 3 parts. Okay. In fact, there are 3 parts. One is confidence level. Then there is a mean, and then there is a variance. Okay. The 3 parts over there. So depending on that, the value of your bond changes. The confidence intervals are, you might have heard of these 3 confidence levels, intervals or levels also you can call it. 68%, 95% and 99.7%. Okay. So these 3 are the important parameters while calculating the value at risk. So what is the correct answer then? So the correct answer over here is D. Okay. The dash method for calculation of value at risk is deterministic approach. Dash method, see this, is a deterministic approach. Correlation method, historical simulation, Monte Carlo simulation, and all of the above. Think over it. Deterministic, firstly, what is deterministic? Deterministic means what? Deterministic means what? Deterministic means there is a relationship between the 2 parameters. That's the meaning of the word deterministic. Relationship between the 2 parameters. Okay. And the relationship between 2 parameters is done in which method? You might have studied this in your APM. In which methods we have done, we use this between 2 parameters. Do we use it in historical simulation? Do we use it in Monte Carlo, or do we use it in correlation? Answer fast in the comment section, everyone. Comment section. Dash method for calculation of value at risk is deterministic approach. Let me think. You should think, not me, isn't it? Yeah. What is the correct answer? Okay, the answer over here is, I'll explain you all. The answer over here is correlation method. Always remember that deterministic means comparison between 2 parameters. You should be able to get the exact answer. 2 parameters comparison. Comparison. Okay. And exact answer. These are the 2 points about this. Exact. Okay. Historical simulation and Monte Carlo simulation are scenario analysis. These are known as scenario analysis. Monte Carlo is for scenario analysis. This is scenario. and historical simulation is related to shear. Again, it's a simulation only. So these are simulation methods, and this is also related to back testing back. But this correlation method is a deterministic, means here exact answer you will be getting. So correct answer is A over here. The historical simulation approach in the market risk calculates the change in the value of the position using. So this historical simulation approach in the market risk calculates the change in the value of the position. Means, what do you mean by this? See, this historical means, what did I give you? I gave you, what did I give you? Give you, not give you. Okay. What did I give you? The historical simulation approach in the market risk calculates the change in the value of the position using the actual historical movements of the underlying assets starting from the current value of the asset. Projected historical movements from the underlying assets starting from the current value of the assets. Actual historical movements of the underlying assets starting from the future value of the assets. Sample of randomly generated price scenarios. Very confusing. Okay, everyone think over it. Very confusing. Yeah, think over it. I'll just wait over here. See this, I'll give you a few hints over here. Actual historical movements. Actual historical movements. Second is projected historical movements. I'll give you the hint over here. Actual historical, projected historical, and depending on the current value. So these are on current value. Okay, current value, current value. Third, C1 is actual historical movements depending on the starting from the future value. Now you think over it. And last one, okay, sample of randomly generated price scenarios. Forget this. So the answer is between A and C. Think over it. A and C. What do you think should be the answer? Think over it logically also. Suppose if you don't know the answer, in exam it happens many times that you don't know the answer. So in that case, what will you do? First, you go on. You should go on this elimination method. Elimination means randomly generated. First, eliminate that. Nothing is randomly generated in statistics. Then projected historical movements. Projected. How can the historical movements be projected? Historical movements are actual movements where we have seen the actual thing. You can't project history, right? So B is also gone. Now A and C, actual historical movements based on the current value and actual historical movement based on the future value. How can I start from the future value? I don't know the future. So the correct answer over here becomes A. Okay, it will become A. A is the answer. Okay, next one. The Monte Carlo simulation method calculates the change in the value of the portfolio using. So Monte Carlo simulation. This Monte Carlo simulation, what is this Monte Carlo? Firstly, understand this. Okay, I'll give you in one line. Actually, it is a deep session which I do take in the paid classes. But in one line, I'll give you. Monte Carlo simulation means what? Here, it's a refinement scenario. Refinement. Refinement means what? Refinement. This is known as refinement scenario. What is refinement scenario? It means that suppose if I do the session today, means if I do a meeting today or think of any scenario today, okay, then my team will sit over here. My team of, let's say, 5 members sits over here, decides on various points. After it decides on various points, means that meeting comes up with 5 points. After these 5 points, we refine those 5 points, and next time when we discuss, again we'll be sitting. So there'll be around 3-4 meetings or 3-4 refinements, we call it refinement. First refinement, then second refinement. Again these 5 members will sit, and when we sit for the next time, okay, we will discuss only those 5 points which we had come up in the earlier meeting. Okay, so only those 5 points. From here, what happens? We come up with, let's say, finalize on 2 points. So now we finalize on 2 points. Okay, I'll just write the points now. 2 points. Okay, one sec. So here there are, let's say, 10 points, 50 points, okay, 50 points. From here we refine to 5 points. Second meeting. From second meeting we refine to 2 points, okay, means we are going on refining the scenarios, what all can happen. So that is Monte Carlo simulation, and in the end from the 2 points we come up to the single point, which is our main answer. So that is Monte Carlo. It goes on refinement. Means this I have given you in the layman's language. Okay. The Monte Carlo simulation method calculates the change in the value of the portfolio using actual historical movements of the underlying assets starting from the current value. Now see here the answers are similar to that earlier one. Projected historical movements of the underlying assets using the current value of the assets. Actual historical movement of the underlying assets starting from the future value of the assets, and sample of randomly generated price scenarios. Answers seem to be similar. Answers seem to be similar, but the answers are different over here. Again go on refinement. Here we are talking of Monte Carlo simulation. Means here various points are considered. All the points, all the required points, all the required scenarios are considered. All the things which can happen in the world are considered over here. So what all things can happen? Can happen. See here, Monte Carlo simulation is can happen. Look at this. This is futuristic. Okay? Futuristic. So can happen. Can happen. Now when I say can happen, then what happens? This history goes off. History is of no use to me. Okay. Now the answer can be only this: actual historical movements of the underlying assets starting from the future value of the assets, and sample of randomly generated price scenarios. Now the real fight is between C and D. Think over it. What can be the answer for C and D? What can be the answer? Either C or D. Think over it. Yes. What do you think? The correct answer is, think things here. Again apply the elimination method. Monte Carlo simulation means it can happen. Whatever things can happen in future. That is Monte Carlo. Okay. So whenever you think of future, firstly eliminate the history part. Now you can see the history part. You can look at this C, but there's the word of future. That's why I've kept it. Otherwise C is also elimination. So the answer over here is C is also gone. So the answer will be D. Sample of randomly generated price scenarios. Remember, randomly generated, because what all Monte Carlo simulation is used for checking the future scenarios. These 50 points, 50 scenarios will be randomly generated. Out of these, various thinkings will be done, discussions will be done, and then we'll come up with, here I've given the example of 5. We can come up with 25 first. From 25 we can come to 5. From 5 we can come to 2. That's the way it goes. Okay. So the answer is D over here. In which of the following methods to calculate the change in the value of the portfolio, the user has not to make any explicit assumptions? Not to make, remember, not to make any assumptions. No assumption is required. No assumption is required means what? It means that directly whatever are the facts, use the same. Whatever are the facts, use the same. Think over it now. Answer is very easy in this, and it means I give you the hint also. Whatever are the facts, use them. So where are the facts? In which method are the facts? Correlation, historical simulation, Monte Carlo simulation. A and C both. Correlation and Monte Carlo. A and C both. Generally we have a tendency in exam, whenever we see this A and C both, or all of the above, or something A and B like this, so we tend to answer that A and C or A and B. Comment section. Give me in the comment section, everyone. Give it in the comment section. So it is Many of you have the tendency of typing A and C. So the answer is not D. Remember, A and C both is not the answer. Either A, B or C. But now we are talking about only facts, no assumptions. So no assumptions is a part in history. In history, do you make any assumption? No, right? So B is historical simulation. This is the answer. In historical simulation, the user does not have to make any explicit assumptions. Okay? Which of the following is the usefulness of VAR? Means value at risk is used where? Why VAR is important? So, number one, good tool for fund managers to for protection of customer businesses. Okay, good tools for fund managers to protect the customer businesses. So that is the first answer. Second one, think of it. What is the second one? Yeah. I'll make it a bit simpler. Okay. Think of it. By the time you read, what is the answer? Now give me the answer. A good tool for fund managers for protection of customer business translates portfolio exposures into potential profit and loss impact. A vital component of the current best practices in the risk management. Meets the external risk management disclosure and expectations. 1 to 4 all, 2, 3 and 4. 1 and 4 only, and 2 and 3 only. Okay, let's discuss these 4 options. Good tools for fund managers for protection of customer business. Is it a good tool? Value at risk. I gave you that example of value at risk. Reliance 3000, 5% fluctuation, 150 here or there, right? So total 300. So if I know the fluctuation of any stock or any commodity, will I be able to protect my or not protect, actually no, protection is not, will I be able to minimize my risk if I know the fluctuation? Yes, I can. So that's why my business funds will be protected. So A is the answer, 1 is the answer, right? So that's why this is the right answer, 1. What about the second? Translates portfolio exposure into potential profit or loss impact. How much can be the profit, how much can be the loss by the fluctuation of that Reliance share by 5% here and there? Definitely that I can predict, right? Means how do the banks predict that this year our profits will be around this and this? How do the banks predict? Banks predict based on your VAR. Okay? A vital component of the current best practice in the risk management. So current best practice in the risk management. Remember, VAR is the best tool nowadays available for any banking calculation. Any banking. Okay? So C is also the answer. Meets the external risk management disclosure and expectation. So this is a important condition in the Basel norms. External risk. Basel norms consider systemic risk, very important. Systemic risk is an external risk, which is not because of you. It is basically the settlement risk. Okay, means a part, systemic risk is a part of your settlement risk. So it meets the external risk management disclosure and expectations, which are required by the Basel norms now. So the answer is all 1 to 4. Correct? 1 to 4. Remember, this external risk management disclosure is an important part in the Basel 3 now. Basel 3, remember. Basel 3, I'll write it. Basel 3 is an important term. 1, 2, 3, okay. Important term, and all the banks are now following Basel 3. Okay, those who don't know, we are all at Basel 3 now. So that's why I'll again tell you, join the paid classes. Okay, here we are covering all the important points. The process where the model based VAR is compared with the actual performance of the portfolio is known as back testing, stress testing. downside potential and duration. Think over it. This I won't answer now. Let me see how many of you answer first. And answer is, I've given you the hints in this session only. The process where the model based VAR is compared with the actual performance. Actual performance. Okay. Where do you base it with compare it with the actual performance? It is done in back testing. Again, back testing, we see here, what is back testing? Back testing means consider the scenarios for last 10 years. Means period can vary. I'll consider it for 10 years. Somebody can consider it for 5 years. Somebody can consider it for last 50 years. Okay? Like COVID. COVID didn't happen in last 100 years, but then it happened. Suppose if I compare, all the banks were comparing their portfolios for last 10 years before COVID. But what happened? One COVID year, last 10 years, I'll give you a simple method, okay? Last 10 years, the fluctuation in the markets was this way, somewhere like this. So last 10 years, there was not a major fluctuation, but COVID came, and what happened? This fluctuation went down like this. So suppose if I consider, if I would have been over here, okay, then I would have thought nothing can come like this. I'll just consider this much VAR. So my historical calculation for back testing was comparing this actual performance over last 10 years, these 10 years. Okay, but what happened? This is the example of stress testing, stress. This is the example of back testing, back means comparing your immediate future, immediate past somewhere. But stress means if something which has not come up in last 10 years, if that comes up, then what? That's the use of Monte Carlo simulation. Monte Carlo simulation is used to check various unseen scenarios. So the answer over here is actual performance of the portfolio. It is compared with this, so it is back testing. So back testing is used for limited purposes, for normal trading conditions. Normal trading. I can't use backtesting for the extreme trading conditions. Okay, we call it a tail theory. Okay, we can't use it for the extreme conditions. Okay. Which of the following is used to determine the possible changes in the market value of the portfolio that could arise due to non-normal movements? Non-normal. Normal means what? I just gave you that example. Backtesting, normal. Non-normal means backtesting, stress testing, downside potential and duration. Backtesting, stress testing, downside potential and duration. Remember, downside potential means what? Downside potential means what? Now see here, you all guys will get confused between C and B. Okay? B and C you will get confused. Non-normal movement. So where do I use this, in which method do I use this non-normal movement? It is this. So this stress testing, this is the non-normal movement of this like COVID. So this is checked in what? Strictly backtesting is not the answer. Duration is not the answer. Okay, duration is totally different concept. Okay. So what is it? Stress or downside? Stress or downside? The correct answer is yes. The correct answer is stress testing. Remember, just now I gave you this meaning of the stress. What has not happened up till now? That's what is the meaning of this word non-normal movement. What has not happened up till now can happen, and that is used in stress testing. So in stress testing we use various scenarios now. Can this graph go up to this part or up to here? Can it go up to here? So what all scenarios can be there? That all scenarios are tested over here. Okay. So stress testing is the answer. And the last question for today. Which of the following techniques are covered by stress testing? Which techniques? By stress, okay? Simple sensitivity, scenario, maximum loss and EVT, extreme value theory. 1 to 4 all, 2, 3 and 4, 1 and 4 only, 2 and 3 only. So which are covered over here? Think. Now the answer is simple. Stress testing covers simple sensitivity. Sensitivity means what? Fluctuations. Now these are means these we are having again deep meanings in it. Today I won't be able to explain you. Means it will take much time. Simple sensitivity, scenario, maximum loss, and EVT. EVT is extreme value theory. Extreme value theory means what can be my maximum extreme losses. Maximum loss means what? What can be my means no profit and all losses. You had the similar concept of maximum loss in your JAIB. That was called as, there were total 11 concepts, right? Remember them? 11 concepts in your accounting. Matching concept, then historical concept, then your entity concept, right? Then dual accounting concept. And one of them over there was conservative concept. Conservative. That conservative concept means this. Okay? It means that. It means this. So one of the approaches over there was conservative concept. Okay? So that conservative concept is similar to that of this maximum loss theory. So what is the option over here? The option is correct. 1 to 4 all. Okay? All of them are considered in stress testing. Got it, everyone? Shall we move on? So now before going, kindly note all the batches of CAIIB. See, victory batch is going on and there's a Mahapack. Join this victory batch ASAP. Okay, ASAP. Why? Because just now it is started and all the numericals, objective questions, case studies are covered. All the compulsory subjects are covered. You can join the Mahapack as well. Mahapack. Okay, let me show you. And importantly, there are various discount offers going on over here. Let me show you. I'll always suggest you to go through the app. Always join it through the app, because in the app you're getting the coin systems which will give you 1% extra. Okay, which will give you 1% extra. So that's why use the app. Okay, say this, go to Adda 24/7. Okay, here click on JIB and CIB. Look at this. Once you click on JIB and CIB, you'll see this victory batch. Okay, say this, click on J. I'll show you from the starting. Go to Adda 24/7. Click on JIB and CIB. Here you will see the batches now. Click on CIB June. Now you will see the victory batch. Say this, victory batch. Click on this victory batch. Here you will see all the details of the batch. Say this, ebooks are covered, test series, online live classes, expert faculties, interactive classes, recorded videos, limited size batches. And look at the discount offer. Click on buy now. Now I'll give you a special code. Special code. Use the code Y432. Click on apply. Now look at this. What are you getting? You are getting 80% off. 80%. Let me maximize this. 80% off. Okay, 80% off. And if you join the Mahapack, you will be getting 80% off plus. Let me show you. See this, CIB Mahapack, 80% off plus double validity. Now, do you want 80% off? No. Go through the app. You will get 1% extra, so you'll be getting 81%, because in the app you are getting the coin systems. Again, click on this CIB Mahapack. Look at this. You are getting ebooks, test series, online live classes, interactive classes, regular test series, everything you are getting. Okay. Recorded sessions. In fact, remember, recorded sessions, class recordings are very important. Why? Because if you miss out on some day due to some bank pressure, anything, you miss out on that, what will happen? You will miss out on that knowledge. So you shouldn't miss out on that knowledge. So you are getting the recorded sessions. Click on buy now. Use the code Y432. Again, Y432. Click on apply. Look at this, 80% off. Plus double validity. Say this, 6 plus 6. So 81%. 80 and 1 through the app. So join immediately. Okay.